All right, this is going to be recorded. One thing I say at the very beginning of all of these videos is if you're new to trading options or new to this particular strategy or how I teach this strategy or how I implement this strategy, watch it again because first time through some of the nuances could really fly by you rather quickly and it'll help make it stick in and help you remember it for longer. If you wait a month down the road, it's just going to be like relearning it again. So this is an options workshop on the ratio put spread. So basically what we're doing is we're taking a long put spread and adding a little risk to it in order to increase our probabilities of success with this strategy. So, buying puts or buying calls or buying put spreads and buying call spreads is pretty much a lower probability of success strategy. This way, anytime you can do something for a credit or add a little bit more risk to it, believe it or not, you're actually increasing your probabilities of success. And another thing is this isn't necessarily going to be appropriate for an IRA, but I'm going to show a different way to kind of add a long put to it that will make it appropriate for an IRA. It will not necessarily increase or decrease your risk, I should say. But it will make it for the IRA police to allow it. All right, so anyway, got to go over a couple of things real quick. My name's Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Been trading my own money basically for 25 years now. I started out trading in college with some money I had earned and decided to switch over to finance, and upon graduating college with a finance degree, moved straight up to Chicago and started working on the Chicago Board of Trade. So I've been around the block and I've traded in most markets throughout my career. From the Chicago Board of Trade, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. All right, so got a disclaimer really to go over real quick. Any opinions, news, research, and analysis or other information contained here are material provided by ProTrader Strategies and associate companies or employees, is for general commentary. It does not constitute investment advice. The reason why is I don't know your risk parameters. I don't know what's in your portfolios. So anything I'm doing may be counterintuitive to what you're doing or to your risk parameters. So take all of this that we're teaching you and implement it into your portfolio in your own way. And also there is risk of loss or substantial loss with trading, so keep that in mind. And past performance of any trading system or methodology is not necessarily indicative of future results. Wolf, why did you ditch your degree to trade options? Well, I actually moved. I ditched my psychology degree because I started trading with a psychology degree and switched it over to finance because I thought that that would help me. Actually moving to Chicago and working on the floor of the Board of Trade, I realized that the psychology degree probably would have been more important and suited me more in trading using psychology and everything else. And then I actually had moved to Chicago thinking I was going to work there for a short period of time for a summer job, and I wanted to move out west and ended up there for a little over 20 years. So I just, trading on the floor, there was nothing like it. I mean, it was just an absolute blast. Anyway, you can also follow me on Twitter at Wolfman's blog, and you can follow ProTrader Strategies on Twitter at ProTraderStrat. Pretty amazing story. Today I was talking to a friend of mine. He called me up and was griping about Amazon. He tried to get a hold of Amazon sales service for a website. Was thinking about setting up a website. Called me up and was like, I'm going to short Amazon. I'm so sick of this. 3 days in a row I've tried to get a hold of the sales department. Nobody's calling me back. I'm going to short them. And I was like, dude, tweet it out on Twitter. And he goes, yeah. So he goes on Twitter, tweets out to Jeff Bezos, at Jeff Bezos, I've just a heads up, I've been trying to contact your sales team for 3 days with no response, and literally I was still on the phone with him. 2 minutes later, he got a phone call. It's a pretty crazy story from today. So needless to say, he didn't end up shorting Amazon. All right, so this is a great strategy to use in bearish market with a bearish market assumption. You can also be neutral to bearish in a sense, and if this market continues to rally, the way I set this up, we will still be profitable. So that's another reason why it is a higher probability trade, because with a put spread, you know, you need the market to go down or you're going to lose whatever debit you paid. We're going to create this as a credit spread. So in that, if the market rallies away from us, we get to keep that credit we initially set up this strategy like. So if we collected 50 cents at the beginning of this strategy, then we get to collect that even if it rallies. If it sells off and doesn't really go too far past our short puts, then we'll be able to collect a nice credit. So it's a nice strategy because it's very dynamic in a sense. The way to set this up, it's called a 2-by-1 put spread or a front ratio put spread. I always just say it's a ratio put spread. And it's a 2-by-1 because if it were a 1-by-2, basically, that makes it a back ratio spread, and you'd be doing it for a debit. So it's a 2-by-1 in this instance. So we're going to be doing it for a credit. A Trump played tweeting. I like it. It was crazy. I literally couldn't believe it. I was on the phone with him. He goes, hold on, and clicked over and find out that it was Amazon sales team calling him. I thought that was crazy. Kind of blew my mind. Anyway, like I said, this is a neutral to bearish assumption, but you know the beauty in this trade is if it rallies, we're still going to be able to at least keep that credit we set this up with. And don't set this strategy up as a debit. And there's a lot of instances. It's not easy to set this up to make sure it's a credit. And there's even some underlyings that with the montage, the option montage just won't allow it to happen. It's just don't do this strategy if you're doing it for debit. There's no sense in increasing your risk and still having to do it as a debit. So keep that in mind. If you take anything away from that, anytime you're doing a ratio put spread or even a ratio call spread, do it at least for no cost, which is $0, or and that's not including commissions, or a credit. So so that you can justify that extra risk. So basically what I'm saying is we're buying one out of the money or at the money put and selling two further out of the money puts. Now I set this up with the out of the money puts. If you're less bearish on this strategy, like you think, well, there's a slight chance, or you have it something like on a Fibonacci level, it's kind of bouncing along a Fibonacci level, and it's at the money, then that's fine too. I like to go a little bit further out of the money just to increase my probabilities of success, and we'll talk about that as to why, because this out of the money put really is going to have a very small delta, which it is a very small probability of being in the money at expiration. All right, so picking the right strikes, I kind of hinted on that with buying the out of the money one or the in the money one, or sorry, the at the money one. I like to set it up a little bit out of the money and picking about a 30-ish delta and then selling around the 16 delta. So that's how I'm going to kind of set this up so that I can get a credit. Bottom line is picking the right strikes here is you need to get a credit for this strategy. That's the takeaway for picking the right strikes. And then the right duration, we want less than 45 days to expiration on this because we're going to be trying to take advantage of the decay in this. Plus, because we've added a little bit more risk, we want some, we want this theta decay to happen to those two short strikes that we've sold, because that's where our credit is coming from, that extra put that we sell. So we want to see that stuff really start to come off rather quickly. If you're out here, it's going to take a lot longer, and in my eyes, you're increasing your risk. So kind of shoot here in this 45 to 35 day area so you get this massive theta decay. Another thing is picking the right environment. We need to have high volatility in this. Anytime we're doing a strategy for a credit, we want high volatility, because the probability is when you have high volatility, the volatility will come out, you know, barring that there's not an earnings event or something like that in there, or in the case of like Amgen, a drug trial result. So we don't want to be heading into a drug trial result necessarily unless we planned on keeping it through that event, because then that's when you're going to get your volatility collapse. But if there's nothing binary going on, and a binary event just means a known event that there's going to be major news around that underlying, in a clean month when we have high volatility, we want to take advantage of that volatility coming out, because again, that is what is going to suck the premium out of those short strikes that are really financing this whole entire strategy. Picking the right underlying, and this is really important, you guys. I mean, there's so many stocks out there that you can trade, and believe me, I talk to people all the time that are like, you know, I want to trade XYZ, and there's just not a lot of participation in that underlying. It's one that everybody knows, and you know, Colgate-Palmolive's one of them. I mean, they have kind of wide markets. What's another one? Like AutoZone. Everybody's heard of AutoZone, but there's not a lot of people in those options. There's a lot of trade going on in those stocks, but it's just not trading in the options. So the bid ask is really wide. So one of the rules of picking the right underlying, look at that bid ask in the option montage, the ones that are kind of close to the at the money or just out of the money. And if it's inside of 10 cents for a $100 stock or less, then that means that there's a lot of participation in that. It means people are constantly trying to outdo one another to make a tighter market so that they can get filled. And that's what that comes into. In a stock that's over $100, I usually say, you know, kind of ballpark it. And if it's a $300 stock, move the decimal point 3 ticks to the left, 30 cents. That's how wide those underlying should be. On a $1,000 stock, you move it 3 ticks to the left and it's $1, right? So those should be at least around $1 from between the bid and the ask. All right. And then knowing our exit strategy with this, we want to take about 50% of our max profit potential. And I'll go over the max profit potential or max profit here in a second. But we want to take about 50% of that because, again, we have risk on the table, and the bottom line is if you're beating the probabilities and you get 50% of your max profit, take it and run. I can't tell you how many times where I thought, you know, I'll wait one more day on this and see if it's going to work out maybe, and I'll tell you what, it just doesn't. The times it doesn't work out are going to beat you up more than the times that it does work out for you. So just don't take that risk. You know, there's nothing wrong with taking money off the table for a profit. And with this strategy, somewhere around 50% or less max profit potential, depending on your comfort. But you know, make that a hard thing. Don't try and squeeze any more than 50% of the max profit potential out of this. So when you buy, volatility is high, hoping that volatility will drop before you exit this trade. Yes. So in a sense, because we're doing it for a credit, we're actually selling this strategy. So it's like a long put spread in a sense when you're setting it up, but you're selling that extra short put. So it really is, you're selling this strategy. I may just be the wording, but we want the volatility to contract. Because if volatility expands on us, for one, it's going to hurt us at our, the one that is at the money, let's just say, or the one we buy. That one's going to hurt us a lot. And the short ones are, it's going to inflate. That will help us. But those two short ones that we are short, since we're short more of those, that's going to hurt us more because those premiums are going to inflate, and it's going to make it more of a credit in a sense. So, you know, although we are getting help from the one that we bought with the expansion and volatility, those two that we're short are going to hurt us more because we're short more of them. Does that make sense? All right, so the max profit, we're going to take our long put minus our short put or a short strike plus the net credit received. So that's our max profit. Being if it was, you know, the long strike was a 50 put and the short strike was a 45 put, that $5 plus, say we collected 50 cents, our max profit potential is $5.50 on this. And that would be if at expiration the underlying was trading, let's say, a penny with no days to go at expiration, a penny higher than our short strike. So it'd be trading 45.01 at expiration. But we're not going to take that all the way. So in that, our max profit, 50% of our max profit, we're going to be looking to get out of this at around $2.50 or $2.75. So somewhere right around in there. All right, our max loss is the short strike minus our max profit. So the short strike is the two that we're short. So those 45 puts were short. And then minus the $5 wide, okay, and that 50 cents we talked about. So our max profit was the width of the two strikes plus the credit. So if you subtract that from the short strike and the 45, we collect, so at $39.50, we start tabulating that to zero. So $39.50 to zero is our max loss on this if that underlying went to zero. So you take the 45 strike, which is our short, minus our max profit potential, which is $5.50. That puts us at $39.50. So we could lose money from $39.50 all the way to zero. Does that make sense? 2 times the short strike, yes. We are selling 2 of the short strike. You're saying, do you mean 2 times short strike? I mean, if we're talking about we're selling 2 of the short strike, that's not really calculated into the max loss. We're just taking that max loss strike and then subtracting out our max profit, which in a sense, the break even is the short strike minus that max profit, which is the $5.50. So our break even in this example is $39.50. So every penny past $39.50 to zero would be our max loss, but our break even is right there at $39.50. Because remember, you know, our max profit is the width of the strikes plus that credit received. So that's what brings that break even so far down. All right, so this is usually a part of the webinar where I throw it out to you guys, and we will look over a couple of strategies. So throw out some different underlyings. Now remember, we want to keep this above a 50% IV, which is this right here, IV percent. We want it above 50. This is implied volatility. So we want this to be currently in the upper half of where it has been in the last year is what I usually look at. You can, some people go the last 6 months and then tabulate that themselves, but we want this to be in the higher half at least, and really not have an earnings event coming up within that. That you can obviously see. These are all the underlyings I look at. There's very few, so I'm going to bend that rule for the sake of the example, but in real world example, please make sure you try and do this with a higher volatility, because we want it to come out, unless you completely thought that it was going to collapse for some reason. But keep in mind, any of these down here in the 20s, teens, zero, all of these down here, probability is volatility is going to go up, and it's going to hurt you when it's way at the lower end of the range. So we want to really try and stick with something a little bit higher, but for the sake of example, we'll probably look at a few that aren't necessarily that high, because there aren't any, unfortunately. All right, Craig's got one. We'll go with Craig's real quick. DDR. I don't know if I've ever traded this one. It has really low implied volatility. I'm sure it doesn't have earnings in this next cycle. It just had its dividend. So let's look at this. So they have 10-cent wide, so that's pretty decent. I mean, but because there's such low volatility in this, you can see that there's just not anything in there to do this. Like, we'd be buying this one right out of the money, and we wouldn't be able to finance it for one. Two, it's only a $13 stock, so 10 cents wide. It's making me think that there's probably not a lot of participation in this underlying. And the reason why that's so important is because, see, there's not a whole lot of open interest. So like, if you were the only open interest for the most part, it's like you got to find that counterparty to take you out of this trade, especially if you're right. And you're going to end up giving up so much edge to get in and get out of these underlyings where there's not a whole lot of volume and open interest, that it's going to eat away at your profit. And if things start getting really busy, they're just not going to be here, because everybody who traded this with you is probably going to be back into their Tesla to try and get in and out of that stuff. So they're going to leave this until it comes back in. Plus, you can see the deeper in the money, and if we are correct, it gets even wider and wider. So I might look to pass on this one, Craig. So IWM, Dale's got IWM. He's got a sell. He's got liking the indexes. So that's a great point. And Dale, I'm glad you threw up all of these indexes. With indexes, so for the underlying, my rule is above an IV of 50. For an index, a basket of underlyings, the volatility isn't ever really going to, or I shouldn't say ever, isn't often going to go above 50, because some of them are less volatile than the others. So it's going to kind of level it out a little bit. So on an ETF or a basket of goods, an index, then we're going to be looking at doing above 30 IV percent. So that above a 30 IV percent for these is considered high. So I'm going to narrow this down a little bit. So this has, I mean, all of the indexes have super low implied volatility. So as you can see, it's at its 52-week low. So the likelihood is, I mean, it could go lower. Don't get me wrong. It could continue to go lower. But to me, it's just like we're kind of primed to get a little bit of volatility. But I feel like I've been saying that for quite some time. So this is a good example, though, of a lot of open interest. I mean, this is just the volume today alone in this one underlying. This is the open interest. So, Craig, when we were talking about DDR, everybody's going to be coming into this when the going gets rough or it gets busy. It doesn't necessarily mean volatility's got to expand in that situation, but when it gets busy, people are going to leave those markets and come into these. Or it could stay low. You're right, John. It could stay low. You're right. But I play the probabilities, and you know, that's another thing I learned on the floor was that at the end of the day, you know, if you can stop thinking about a trade, for one, if you're thinking about a trade as if it is money, lost or gained, then you're, one, either trading too big, or two, you're looking at it wrong. You should be looking at it as probabilities. Have I beaten the probabilities, or are the probabilities beating me? And look at it that way. And it will make you a lot more secure in what you're doing. You'll have a lot more confidence. Whenever you're mechanical and you're just going through the steps, boom, 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 this is how you do it. 50% of max profit, I'm out. I don't care. I don't care if I think it's going higher. I'm getting out. You'll do much better, believe me. And I make the mistake every once in a while too of, all right, well, I'm going to let it go for one more day, and believe me, it is a kick in the pants when it doesn't work out for you, because you're just like, why didn't I stay mechanical? And the other thing is, when I close it for 50% of my max profit, I don't even look at it the next day. I don't even want to know. I don't want to change my mind on that. So IWM has super low implied volatility, and something like this, if I were bearish, I would probably just do the put spread and pay the debit and look for it to work out that way. So I'm going to pass on IWM. We could look at SPX. And if you're trading with one thing with SPX is it's the big dog, you guys. So if you're trading SPX versus SPY, you should probably have about a portfolio value of over $100,000, because otherwise you would be really have a heavy weighting in one particular strategy. And another thing with this is, with strategies, don't allocate any more than one strategy to your portfolio, more than like 15 to 25%, and don't have any one underlying any more than like 10% of your portfolio value. So one thing about SPX that's beautiful, especially if you have a large account portfolio, this is a good way to kind of hedge that downside risk if you're long a lot of stock. So having said that, keep that all in mind. What do you think about 3-time ETFs? Dale, I don't do them a lot, like TBT and stuff like that, but I do get in there every once in a while, and I do like those. But, that is you need to have a higher risk parameter, right, in order to trade those. So, but I don't have any problem. I'll trade 2 raindrops against each other, Dale. As long as there's open interest, volatility, and participation, I'm all for it. We used to say on the floor, I'll trade those 2 dead cockroaches. What's the value? What's the going rate? Who can we sell it to? All right. Anyway, so in this, this is one of those, move it 3 ticks to the left, $2.30. So it should be inside of $2.30 because I moved that decimal 3 ticks to the left, $2.40. So the bid ask in this montage should be within $2.50. And it sure enough is, because there's a lot of participation in here. But having said that, it's going to have super low implied volatility also. So I'd like to get a little bit higher volatility for me. If you guys want to take that risk for yourselves, that would be a little bit different. But the thing to do is, I mentioned that like 16, 18, I like to go to the 16 delta because that's about 1 standard deviation. So that gives us a 16 delta. So I'm going to be getting about, let's just say, $7.50, so $15. So the one I would be buying would be somewhere around here because I could pay about $15 for it, and then sell 2 of these. And it's not going to give me a debit, so I would, I'm going to make it easy on myself and just move this to the 45s because I'm thinking that one will get me there easy. So then we get our 50-cent credit. So if the SPX or the SPOOs rally, I get to keep that 50 cents. And if it sells off, basically we've got $50 in between, or it's more than 50. Yeah, 50 in between here. So $50.50 is what our break even is to the downside. So when this is trading 22, 44, 50, that's our break even on that, because I took the width of these spreads, because the idea is we're going to collect money on these 45 puts all the way down to those 95 puts, and then so that width of that spread is our, you know, our gain on those puts, and then we'll start losing money as it goes down, right? So the margin requirements on this, great question, John. They are, it's basically because you're short that naked put, your margin requirements are going to be a lot higher. It's basically because you're naked that put. So it is going to be that one standard deviation kind of thing with, and you know, and everybody has different margin requirements. You'll have to check with your broker, but the margin requirements are higher on this. One way you're not really going to decrease your margin requirements, but one thing I say with this strategy, if I'll find one that has a little bit less. Somebody else threw out one, so we'll look at it. Tesla. That was Stan threw out Tesla, so let me delete this one. Tesla, what's its IV percent? It's 11, so it's pretty low. But one thing I say to do with this one is, let's go to all. If we wanted to make it IRA appropriate, the thing to do is, first, I always look for like around that 16 delta to get this thing set up. And Tesla is a little bit wider than that rule of 26 cents wide here. But you'll see with volume and open interest, everybody hides in the weeds with Tesla. You can see there's a lot of volume and open interest on either side. But there's a lot of players in here at any given time. So one thing to do with this strategy is, I'll show you when we set this up, to cancel replace multiple times before you get filled. If you're putting in an order rather quickly and you're getting filled, you're giving up a lot of edge, if you will, to get filled. So always cancel, replace it. Especially, there's a lot of people in here that are in the weeds and are willing to give up the edge. So just don't even really mess around with that. So we're taking the 15 delta because that's about the closest to the 16 for me. And I like picking this one because it gets me far enough away that the probabilities of Tesla coming down here are rather small. And then we're getting $4.40 because remember, we're doubling this, so I got to think of this as $4.40, and where would I be able to buy one for $4.40 and still get a credit? That strike there, which is the 245s. And you could always go back and cross correlate this with the whatever strategy you're using, whether it's, you know, you're using Fibonacci or something along those lines, you know, or, you know, trend lines and stuff, whatever you want to use to find those, try and get below, you know. I usually use the probabilities and the market profile. So having said that, with this trade, the 35 puts is what I'm concerned about. So 35 puts is below this, what's going to act as support. So it's very comfortable here. So this is going to act as a support. This is going to act as a support. And then if it gets below these two supports, it's going to want to go to these 2 points and settle down. So that's the idea with market profile in a nutshell. But so I would feel comfortable having a support above here and there. And you could always look at your Fibonacci lines too if you want to do that way. So I would be comfortable with something like that. I'm not necessarily comfortable with the low IV in this, but like I said, for example, we'll let that fly only as example purposes. If I were to, I wouldn't implement this in a real world scenario because of the low implied volatility. So that's how we would set it up, so we get that credit. Now, there was something I was going to talk about with the probability. There's something I was going to talk about here, but the probabilities I talked about, that's about a 85% probability that my stock is going to stay out of the money at expiration. So I'm pretty happy with that in that regard. Oh, for the IRA, thank you, perfect. So for the IRA, what we want to do is, this isn't going to decrease your risk at all, but what I do is go out here in time and buy the first one that I can just pay a nickel for and continue to keep the credit. Now, if you're doing this for $0, then you're going to be doing this as a debit, so it doesn't make it worth it. But if I can do it and still do it as a credit, I buy the first one I can for a nickel. Let's just say that this is the one, and then buy that one in, and it creates a broken wing butterfly in a sense. So it doesn't follow the rules of my broken wing butterfly setups, but in a sense, that's what you've created. And as a matter of fact, just throwing it up here is a butterfly. It's a broken wing butterfly in a sense. So, but that makes it IRA appropriate, and you're still getting a credit. But it isn't decreasing your risk, because really the probabilities are saying there's a 0% probability in the next 35 days that Tesla is going to be trading 150. So you see what I'm saying? You haven't decreased your risk at all. Another thing with pulling the ripcord on this to get out, I look at it as 2 times what my loss would be. I'm getting out of this at around 2 times what my profit potential, or what I was going to take as a profit potential. So in that, on a strategy like this, our profit potential here is the $10 plus the, so I'm shooting for a target of $5 gain on this. So when I see my credit coming around $5 and 20 some cents, I'm looking to get out. So I double that. So $5, doubling that is $10. So basically the width of. So 2 times what my max, or what my max profit possibility is as a loser. That's where I'm going to be looking to get out. So it'd be like $10 on this. So I'd be doing this very small. Does that make sense? I set up a scan and toss for options, implied volatility greater than 50% without earnings in the next 35 days. Not much out there. TZA 41%, ANF. Do you use a search? You know what? I usually, if I'm struggling, like I have been struggling to find, I should say, high IV, then yeah, Dale, it's a great point. I do use that. IB, implied volatility percent above 50 without earnings next 35 or 45 days. Yeah, and there's not much out there. As a matter of fact, some of these are saying there's no earnings. Qualcomm has earnings in there in the next 45 days, so that doesn't really work out either. So, but yeah, that definitely, I just throw it over here on my watch list, go to the gears, type in IV percent and add it here. I don't even look at what the stock is. I'm just usually, first thing I look at is IV percent, and then I'll start kind of clicking through the charts and see if I see something set up there. There is a recording for this, Greg. You've missed the first 20 minutes, yes. And for those people that have been here the whole time, it is being recorded. I do say go back and rewatch it, especially if this is new to you. Yes, I would either, so John's asking, so you would either sell it for a $5.20 profit or buy it back for a $10 loss, yes. Because the reason why is if it's at a $10 loss, basically, it's not coming back into my range. But I'm trying to keep my powder dry here. For one, my break even is when it comes down to $25 or say $2.25. But the probabilities of it being there are not very great. The probabilities of it being tested are much greater. Like there's, as a matter of fact, I have a whole class on option hacks that I learned on the floor. But it goes into all that stuff in detail, but the probabilities of this being in the money at the end of the day is only a 15% probability, and that's what delta also tells you. There's a lot of different things that delta tells you. I don't really have time to go into today, but it basically means it's a 15% probability of being in the money at expiration, and that's one standard deviation move. All right, so that's why I always try and set it up at that one standard deviation move and then move back in to buy mine. So I know where I can get it. All right, so I'll just go over a couple other ones that I was looking at for this trade that looked like it was working out. These are working out despite the fact that they have low implied volatility, but some of the ones I was looking at had at least close to a 50% or an IV of 50%. Netflix was one. Let's look at Netflix. And I have this is from our other class on the long, or the, ratio call spread. If you guys were watching that, I put that on for that. So we could look at it for the put side too, because it's working out. And I actually even went a little further out with this one than normal, because oh, actually it's 18, so I went inside of it. So basically we're going to look to sell 2 of these, because that's as close to the 16 delta as I can get, right? And then the 35s, so I can buy those, and then I get a nice 72-cent credit. So low probability of this really losing money. Excuse me. If it came down into the 30s, you know, I have a lot of room to the downside. I've got 25. It could be trading close to 124 before I'm, you know, getting past my break even, 124.28 or 24.28 is my break even to the downside. So I could play this, and I probably wouldn't necessarily play it because I've got this other one in there, but it's got pretty high implied volatility, and I believe it's a pretty clean month. May have actually earnings coming in. Actually, I might have done that as just a long call spread from a while ago, because it has earnings. Let me just check. Yeah, it does have earnings, so I'm actually looking for IV to expand on that. On that trade. The other one was Alta, which kind of Alta is one of those, again, kind of like Tesla. Why didn't that? Am I doing that right? Alta. You know, it kind of stretches that boundary. It's a $288 stock, so I'd say like 29 cents. It's usually right around 30 cents for the bid ask, so it's pretty close to that, as you can see here. So this is a pretty good one, and not a lot of people talk about this on mainstream media, if you will, but it does have pretty decent volume and pretty decent open interest, but it does have really good tight markets. So we're looking to finance. It's going to be about, it's giving me the 130, so, you know, we're thinking 140 probably. So that's about $2.80, so I could buy this one and get my credit for it on that. So that's another way to set it up. Another thing with high implied volatility, Alta doesn't have any implied volatility, but it works out. The higher the volatility is when we get into this trade is essential also because it allows us to make this bid, or our long put and our short puts further apart. Like this one, you can see I'm doing it on the $5 wide with super high implied volatility. You know, if it was like 70, 80, I might be able to buy this one and sell 2 and make it a $10 wide. So that's why it's really important. It's also a little bit easier to do this with you know, the $100 stocks rather than the you know, anything less than 50. So somewhere between 50 and up, I would say, but the sweet spot seems to be somewhere, you know, with the $100 stocks or very close to that. I found anyway. But the higher implied volatility embedded in this has pumped up all of these premiums, so we're able to kind of make this spread a little bit wider and get a little bit more bang for our buck. All right. Does anybody else have any other questions real quick? I think I got everybody's. If I didn't get your question, please throw that in there. And Dale, thanks for the time on Friday. Appreciate it. No, thank you guys for missing March Madness for me, at least for an hour out of your day. Everybody's got it on in the background and halfway paying attention. And if that is the case, definitely rewatch this video. All right. So we got we've got a offer for you guys today. This is Floor Trader Hacks. I mentioned this about the Delta. It's 9 floor trader hacks. It's all these little shortcuts we learned on the floor as floor traders. It's just easy ways to think about probabilities and what those the option montage is telling you. It's not just telling you Delta, Vega, and stuff like that. Each one of those Greeks I go into and tell you, like Delta tells you like 6 different things, and a few of those you won't even find online anywhere. Some people will talk about the probability, you know, the 16 deltas, the 1 standard deviation move, but I go into like 5 other things that Delta tells you in some of these videos. So if you guys enjoyed this, especially if you're one of my regulars, you need to sign up for this course because it will really save you a lot of time for $479. It will help you change that mentality from being thinking about money and more thinking about probabilities. Also, it's going to save you all kinds of times. You won't be having to pull up a calculator all the time to figure stuff out. It also, you know, I teach you the right things to look at before trading any options. It's obviously, I mentioned it's going to save you a tremendous amount of time in trying to figure different things out, and the probability or being the money, things of that nature. So you also are going to get 6 months free premium membership. So that comes with a lot of stuff. You get unlimited access to me, you get the daily market commentaries, and all sorts of other things. So you can definitely take advantage of that. It's not just these videos. There's every single day I've got a video coming out where I talk about trading options, what I'm doing. I tell you exactly what I am trading, how I'm trading it, how I'm staying mechanical. You know, I've talked about the losers just like I talk about the winners. I probably talk about the losers more than I talk about the winners because those are the ones trying to stay mechanical with and turn into winners. So I'm very honest and upfront. I'm not one of those guys that just touts, you know, talks about the winning trade that I put on and you know, blurt that out. I talk about the losers because I think that's more important. And that's the difference between a floor trader and just some other guy on Twitter or wherever. Floor traders talk about their losers because they're the ones that are top of mind. They're the ones that they are really trying to trade and are excited about when they can turn those losers into winners. So, and guys will be calling you guys about this and can answer any of your questions. And if they can't answer them, they'll get you guys over to me. And this course, you guys, is designed to produce consistent winners. All right, and the link to this is in the chat window. So go to the chat window there. There is a link right there that you can click on. It's easy to get to. Otherwise, if you're watching this on recording, you can pause it and write down this. It's just floor-trader-hacks-for options, and you can get that special offer. But the easiest way to do it is to click on the Pro Trader Strategies thing, and it's a bargain for the premium membership because basically if you just got 50% off the premium membership for 6 months, that's what that cost is. So you're getting 50% off the premium membership and the Floor Trader Hacks videos for free in a sense. You could even look at it that way. So it's a great deal. In later webinars, I'm going to be down on option components, how I trade options, when and where I find them appropriate. Also, reach out to us at ProTrader Strategies via email at trading@ProTraderStrategies, and give us some ideas of some future videos. I'll be happy to cover those and talk to you about them, whether I like them or not, or we'll do a video on there, because some of the strategies out there I don't like at all and don't ever implement into my portfolio. But having said that, I will cover them and tell you the reasons why I don't think that they're the smartest trade. I want to thank you guys for watching. You can contact us at 310-598-6677 or email us at trading@protraderstrategies.com. And remember to write this down, or easier than that, just click on the chat window. We've been communicating back and forth in the questions box, but you can go to the chat window to get that. I get to see a couple more people asking questions. What was the LOL about, Dave? Dale, I missed that. How often do you use this put ratio strategy? I haven't been using it very much lately. I used to use it like this. What the call ratio spread and the put ratio spread, or ratio put spread, however you want to say it, was one of the ones that was probably the most commonly used strategy on the floor by traders. We love them. And the reason why is a high probability trade. You have a lot of different ways to be right with this. If it rallies, you're right. If it sells off, you're right. If it doesn't move anywhere, you're right. So it's a great strategy in that. But you need high implied volatility. And believe me, when we were floor traders, we didn't really look at it necessarily in the beginning. When I first started down there in the 90s, we weren't thinking about how that volatility would kick us in the pants, even if we were right. But that's why I've created these rules over 25 years of trading, because I've seen my mistakes and realized the probabilities, and I've created rules that I try and stick by, because at the end of the day, you'll be a lot more confident with your trades if you go into this with a strategy, an exit strategy. You know where you're going to get out. You're staying mechanical. You know exactly how you set it up to increase your probabilities of success, especially, like I said, make sure you're getting a credit for this. So you're getting like 25 years of my pain, so you guys don't have to have it. So it's well worth the $4.95. I mean, one bad strategy, one bad trade, and that will, would have been paid for, had you learned a little bit. Only thing that we could do to increase our success rate is, build out that gray matter in between your ears, and it'll help you become more confident for sure. Do you post videos on YouTube or Vimeo? Basically, they're on the website. So basically, you go in there, and they're real nice, because you get the videos. There's a whole list of them, and when you watch them, it basically, you check them off the list. It doesn't mean you can't go back and rewatch them, but it just, it kind of helps you out with which ones you have watched. That answer your question? Oh, it was on the March Madness comment, right? All right, that's all I got for you guys today. I won't hold you out anymore. You can go watch the March Madness. Have a great weekend. Thanks, Stan. Appreciate kind comments. If you can't take that, take it easy. Can the floor trader hacks be a purchase with a check? I believe so, John. You'll have to check with home office. They're the ones that take care of that. So if somebody can reach out to John, talk to him about it. They also do, we can set up a payment plan too. So, call that number on the bottom of the screen here, and you can ask them all the questions there, John. 310-598-6677. And if you want to do it on a payment plan or something like that, they can do that too. Or at least tell them I told you you could do that. All right? Take care, guys. Have a great weekend.